You walk into a tea shop, drink a cup of chai, and owe 20 rupees. If you pull out cash, the transaction is simple. You hand the note to the shopkeeper, they accept it, and the exchange is instantly complete. 2 people, 1 piece of paper, 0 middlemen. Today, you pull out your phone and scan a code. From your perspective, it feels the same. You initiate a payment, the shopkeeper gets a notification, and you walk away. But digital money does not physically travel from your device to the merchant's device. It does not fly through the air, and it does not ping across telecom towers like a standard text message. To see what actually happens, we have to freeze time the exact moment you tap Pay Now. We are going to look inside the specific 3-second window that follows that tap, because behind that simple action is a massive machine. It is a system built not to transport physical currency, but to coordinate a series of agreements between major institutions designed to transfer trust. In the first fraction of a second, your payment request leaves your phone, but it doesn't go to the merchant. Most businesses cannot connect directly to every single bank in the country. Instead, your request hits a central routing layer called a payment gateway. This map shows the exact path your data takes. The payment gateway packages your details and hands them to the acquiring bank, the merchant's bank. From there, the data passes through a central card network, which identifies who holds your money, and finally fires the request straight to your personal bank, the issuing bank. Between seconds 1 and 2, your bank's internal fraud engine catches the request. It has a tiny fraction of a second to approve or deny the transaction. It runs down a silent checklist. It checks your device history. It maps your typical location. It analyzes the merchant category and compares the request against known fraud patterns happening elsewhere on the network. By the 3rd second, your bank approves the request. That confirmation signal races backward down the line, through the network, past the acquiring bank, through the gateway, and back to the merchant. And your screen flashes green. Payment successful. That blinding speed is a deliberate design choice. It keeps the consumer completely isolated from the immense security apparatus happening in the background. But despite that green checkmark on your screen, absolutely zero money has moved. In the digital economy, your bank has merely provided authorization. They have verified your identity, checked your balance, and promised to honor the debt. They lower the number on your account interface, and the merchant's bank raises theirs. The actual transfer of funds is called settlement. Think of it like a restaurant bill between friends. Hours or sometimes days later, out of sight of the consumer, the banks and payment networks finally tally up who owes what and clear the physical financial obligations between themselves. The clean interface on your phone exists to manage human convenience. The hidden back-end architecture exists solely to manage the risk of institutions settling debts with one another. This system of digital promises introduces a major vulnerability. If a transaction times out at the exact wrong microsecond, a customer might be debited without the merchant receiving credit. The records suddenly disagree. Resolving this requires reconciliation. Human teams and automated systems have to manually audit the logs from the bank, the gateway, and the network to pinpoint exactly where the chain broke. This is why it takes 3 seconds to buy a coffee, but 3 days to get your money back for a canceled order. A refund requires the system to trace a fractured digital footprint backward through all those independent databases. Keeping these records aligned at massive scale requires warehouse-scale hardware. Payment companies maintain immense server farms, redundant backup centers, and dedicated disaster recovery sites running 24/7. Payment companies spend huge money on backup systems, monitoring dashboards, and cybersecurity teams. Because in payments, downtime is not just a technical issue. Downtime is lost trust. Because they process billions of simultaneous interactions, payment networks have scaled past being mere financial products to become essential national infrastructure. They operate alongside public utilities like roads and electricity. When the servers function correctly, business flows. When a centralized routing node goes down, wide-scale economic activity halts. The convenience of digital payments creates a total dependency. Our ability to buy food or pay for a ride is completely tethered to power grids, internet connectivity, and corporate server uptime. This is the exact reason physical cash has not disappeared. It is slow and physical, but it is resilient. It works in a dead zone, during a network crash, or when your phone battery dies. And there is a second, more personal trade-off. To make digital payments as reliable as cash, the system has to know exactly who is on either side of the screen. Those same fraud engines that allow for 3-second approvals work by turning your location, your device history, and your spending patterns into a permanent, trackable footprint of your behavior. The next time you scan a code and wait for the beep, consider what you are actually participating in. The true modern miracle is not the speed of the transaction, but the invisible, fragile global network of trust that sustains our economy without us ever noticing it.